What I want to do is I want to tell everybody your story. I want to talk about your money problems, not just problem, and I want to get into how we actually solve your money problems with this method called the money multiplier. So how you doing today?
Doing great, thanks.
Fantastic. Well, the first thing I really want to do is I want to help the audience really understand your situation. I'd like to walk through your life, the different things you're doing, like first starting with your goals and your problems. So let's start right there. Like, what are the main things that you really want to accomplish with the money multiplier method?
I want to pay off my debt.
Okay.
I have 3 kids in college. Well, 3 kids to be in college shortly. I want to buy a retirement house.
Okay, so first we want to pay off debt. So Maureen, with your debt, what kind of debts are most important that we pay off?
I have credit card debt. I have a Discover card.
Well, we got credit cards. And is there any other debts outside of like the type of debts that we want to pay off? Like what other ones would we want to pay off?
My car loan. I have an Infinity.
Well, let's pay that Infinity off. All right, so these are the debts we want to pay off. Okay, so that's goal number 1 is pay off your debts. What about number 2? What would the second goal be?
College planning. I have 3 teenagers.
Oh boy.
One is 17, one is 14, and one is 13. So I'm going to have a lot of college bills. 17, 14, and 13? Correct.
Wow. Okay. Yeah, that's going to be a lot. So with the 17-year-old is going to school like right away, right?
Yeah, she starts in September.
In September. All right. Well, we want to take that down. So we got one starting immediately. All right. And how much do you think college is going to be for each kid? This is going to be a number that's going to scare me.
Yeah, it's scary, but I think I calculated it about $22,000 a year.
Per kid?
Per kid.
All right, $22,000 each child. Ouch. All right.
Ouch is right.
All right, so now we've got paying off your debts. We've got 3 kids going to school, so we got to get them into college and get that all paid for. What else? What else do you want to do?
I would love a retirement home in a nice warm climate. Florida, probably.
Yeah, that sounds really good because being here in New York, that's a little chilly. So you're just looking to get out of here. So retirement home, and let's define that. Let's call it Florida. So I don't know. Let's call that $250,000. Might even be a little more, but we're gonna say that's a $250,000 goal. All right. Well, let's see what that looks like real quick. All right, is that pretty close to what you're looking for?
Absolutely. I could see myself sitting in that hammock.
All right, so we've got pay off debts. We've got college planning for the 3 kids. We want to pay for all their schools. We've got retirement home in Florida, roughly $250,000. What else are you looking to do?
I've always wanted a multifamily house for
Multifamily?
as rental property.
So you just want one, or you want a whole bunch of them?
I'll start with one, but that's how we have to start off, right?
That's right. So, all right, so we got a 4th goal. Let's throw that down here. And we want some multifamily rentals. All right, so we got a couple rentals in there. So now we've got all of our goals set up on the screen here. This is what we need to do. We need to solve all these goals, all these money problems, and we need to do it without you having to work any harder, without you having to work any longer, without you having to take on any additional risk, and most importantly, without you having to lose control of your money. How does that sound?
That sounds great.
Great. So now in order to do that, what we got to know is we got to know, what are you doing today? Like, what does your current picture look like today? So what I'm going to do is I'm just going to start another screen here. And I want to kind of, now that we know what your goals are, let's talk about where your money goes today. So first and foremost, like, what is your household income looking like today? So let me just put this up here. Because remember, the one thing we don't want to do is we don't want to change anything. We don't want to change you saving more. I know when I was a financial advisor, the number one thing I always had to do is I had to ask people, how much money are you saving? And if they said, okay, I'm saving this, and I would say, all right, can you save more? The answer was always no. So the next thing came with, if you can't save more, can you take on more risk, right? Save more or take on more risk. Well, nobody likes that. So how about we don't save any more money, and how about we take on a lot less risk than what you're doing now and accomplish the goals doing it that way? That's what I want to do. So first off, tell me a little bit about, your income. So I know right now, I know you work for the government, so one of the good things about the government is your benefit package, which we're going to talk about when we get to the retirement. But tell me a little bit about, what does your income look like?
I make $160,000 a year.
Okay, so we got 160. And then you're married, so we got Benjamin. What is Benjamin's income for household income?
He makes $106,000 a year.
Okay, so we got 106. So if this is your gross income you bring in, there's a lot of things that come out of that, like taxes and everything else. What do you bring home on a monthly basis?
I bring home $7,600 a month.
All right, $7,600. And then what does Ben bring home?
$4,812 a month.
$4,812?
Correct.
Okay, so this is kind of where we're at now. So you got a total household income after the math of about $12,412 a month, $148,944 a year. But what is that going to look like? Now, you told me earlier you're retiring soon, right? When are you going to retire?
22 months.
Whew. All right, so we got 22 months until you retire. So we got that up there. So what does life look like after retirement? I mean, does your income change a lot? Like, what happens after you retire?
We take half of what we made, and that's going to be our income. We're both government employees.
All right, well, let's do some quick math here. So if we fast forward and we look at today being retirement, what does your income look like?
My pension will be $85,000 a year.
Okay, so 85 a year. That's about $7,083 a month. Okay, and then we got Benjamin.
And his will be $60,000 a year.
Whew. All right, so right now your household income with both of you working is $148. With you retiring, your household income is $145 or $12,083. So you're going to take a big haircut when you retire. I'm just kidding. Like, you're right there. But you know what I got to say? I drew this little thing. I'm not going to draw it out, but this little shark here sitting on this lawn chair with a margarita. Goodbye tension, hello pension. Because I'm sure a government job has lots of stress that comes along with it, doesn't it?
A lot of stress, yes.
All right, so this is our current income. Now let's do another one. Let's go into your current savings plan, because all we want to do is we just want to change one thing in your life. That's all we want to do. We want to change that one thing, which is where your money goes first. And that one change will change everything. We'll solve all of those goals. We'll pay down your debt. We'll pay for the college. We'll buy that dream home out there in Florida and get you some multifamily houses in the future sometime. So if we got to change one thing, we got to change where your current assets are going. So I got to know what you've got going on. So what do your current assets look like?
We put into our deferred comp, our 457 plan.
Okay. And you're both doing this, correct?
Correct.
All right. And how much are you putting into the deferred comp? So let's do you first.
The exact amount is $2,999.56 a month. And that's because I'm over 50 and I'm able to do the catch-up.
All right, so let's make sure people know that, because a lot of people are going to think, if you're putting that much in, what can I? No, that you have a catch-up contribution that you're able to do. And then where else are you putting money?
I have a Roth IRA, self-directed.
Ooh, hang on. Most important, folks, notice self-directed Roth IRA, none of those old traditional ones. So we're going to take that traditional investment plan and we're going to get rid of it, and welcome to the new world. So we got self-directed Roth IRA, and how much are you contributing to that every year?
It's $7,000 a month because I could do the catch-up.
Okay.
I'm sorry, I could do $7,000 because I'm over 50.
Yep. So
and
we got
that's
that catch-up.
$583.33 a month.
All right, Maureen. So in your deferred comp and your Roth IRA, your self-directed Roth IRA, you're putting about $35.82.89 a month away. works out to be about $42,994 a year. That's what you're putting away now. But one thing we got to remember is this up here, the $35,994 that you're doing into that deferred comp, that's going to stop in 22 months when you retire, right?
Yes.
Okay. So we can kind of count that, but we got to kind of discount that because we're not going to be saving that amount of money. But what we can count 100% is this. We can count that $7,000 because we know that is going to continue being saved. So what we're going to do is we're actually going to change where this money goes first. So how we're going to do that is this money right here, we're just going to reposition this money and we're going to move where it goes. We're going to move it into this concept called infinite banking concept or the money multiplier method. Let's go into your assets. So real quick, let's talk a little bit about all the assets that you've got. All right, so Maureen, just kind of let's go through and talk about your assets. So what do we got? You said you have money in savings, right?
Yes, I have $25,000 in my savings account.
How do you feel about those savings accounts? What are you making in your savings account right now?
Pretty much nothing.
They're not giving you anything.
Pretty much, I would go with nothing.
All right. I was going to give them a little bit of credit and actually say that you were earning 1%, but it's nothing. So we're going to put a big old fat 0 here, and you know that 0 is not big enough. So you're earning 0% interest. All right. What else do we got going on?
I have a business savings account with $67,000.
What's the purpose of the business savings?
I'm looking for the right piece of real estate that I'm going to buy.
Is that for those multifamilies, or is that the dream?
Yeah, for the multifamily.
Multifamilies, okay.
My self-directed IRA has $18,000 in it.
All right.
My husband's self-directed IRA has $8,000. And my deferred comp is at $389,000. And Ben's deferred comp is at $370,000. And last but not least, I put into the kids' 529 college plans.
Okay. And how much are you putting into those?
$6,200 a year.
$6,200 a year for all 3 kids, or for?
For all 3, yes.
Okay, for all 3, we got $6,200 going there. Perfect. And how much of a balance? Do you carry a balance in there right now?
Yes, it's at $26,000.
Okay, so that's our current assets. We're making nothing on the savings. So here's what we got to do. We got to change this. Folks, you also remember in Maureen's planning, one of the things she had a really good nest egg for her retirement. We didn't even talk about that. But what we did here is we created more wealth for her by taking back money she was giving away. We didn't exclude the money that she had saved. She's going to live a really good retirement. She's got plenty of income coming in and lots of assets to help her build the next phase of her life. You should do the same. I can't have you earning 0% on $25,000. So what we're going to do is we're going to shift this over into this privatized banking, infinite banking concept. Goes by lots of different names. You know, the one thing too that we didn't really talk about yet, like, how did you hear about this? How did we come to meet, and how did you find out about what privatized banking is in the money multiplier?
I think I saw it on Facebook, on a Facebook ad that popped up.
So you're on Facebook, a Facebook ad pops right up, and you're just like, oh, this looks great. I'm going to put all my money into this.
No, I do my due diligence, and I ordered your book, and I enjoyed it. I read it from cover to cover in like 2 days, and you had me hooked.
I'm actually pretty excited that you read my book, and just for that selfless plug, this is the book you read?
That's the book.
All right. So after you read the book, what was the first thing you thought about this concept? Like, what were you thinking after you saw the Facebook ad, you read the book, and you did your due diligence? What's the first thing that came across your mind?
How fast can I start this?
How fast can I start this? I love it. All right, so we're going to take that $25,000 that you have in savings and we're going to redirect it over here. We're going to take the money that you're putting into this Roth IRA, we're going to redirect that. And then you know what? We want to pay the college off, right? We want to pay for college for the kids.
Oh, yeah.
So let's take this $6,200 and let's redirect that as well. All right, so as you can see here, and as the audience can see, the main thing we're doing is changing where your money goes first. We're changing where your savings goes first. We're changing where your self-directed Roth IRA contributions go first, not the money that's already in there, okay, because we're going to leave that for retirement. And then we're going to change where this money is being, we're going to redirect your college planning because first off, I've never been a fan of 529 plans. The traditional places where you put money for college savings like 529, savings accounts, brokerage accounts, all of those assets are countable assets when it comes to filing your FAFSA forms. These assets, these specially designed and engineered whole life insurance policies, they are excluded assets, meaning when you fill out the FAFSA form, none of these assets will count toward your financial aid. So we're going to get that into a better place, and by doing this, by just changing where your existing savings goes, I can almost tell you, well, we've already done all the math, but we can solve all these money problems, but there's a catch. There's a catch, and I think you're going to like it. But before we get into that, we got one more thing to do. I need to understand your debts. I need to understand what your expenses and your debts are. All right, so let's walk through your debts. Let's start right from the top. Should I leave a lot of room?
I have a Discover card.
Okay. All right.
With a balance of $22.45.
What else?
Ben's Discover. So we each have our own.
Okay. How much is on Ben's?
$7,145.
Okay. What else?
I have a TD Ameritrade, and the balance is $3,351.
Okay.
Then I have one last Visa at $5,881. That's a Chase Visa.
All right, so those are the credit cards. What else do we got?
And now I have my car loan, my Infinity. And the balance is $14,000.
Okay. Any other debts that you've got out there?
I have a business credit card that I use only for the business, and that's at $14,774.
14,000. Say that one more time.
$14,774.
And that's Marriott?
Marriott Chase.
All right, so because this is business, we're just going to put this in blue and we're going to call this business because we want to keep that completely separate. Okay. All right, let's see. Let's add all this stuff up here. I'm actually scared to see what this adds up to.
Yeah, me too.
All right, so we've got a total of $42,396 in credit card and car loans debts. So that's not too terrible, not terrible for the amount of income, but let's see how much money right now you're giving away to everybody else. So that's the thing I always like to talk about. If you want to truly build wealth, one of the things you should always think about doing is not going out working more, working longer, taking more risk. I like to think of taking back the money that you're giving away to everybody else, because building wealth would be a lot more fun if all we did is took back all the money that we're giving away to everybody else. So let's talk about all these debts and how much money are you giving away. So out of all these, how much is being given away? I'm going to actually say given away. So on that Discover credit card, how much goes out the door every month?
$200 a month.
Okay, how about Ben's Discover card?
$200 a month.
Okay. And then TD Ameritrade?
$149 a month.
That Visa Chase card?
$214 a month.
All right, how about that Infinity card?
$468 a month.
And then last is that business card. So you owed $14,774. How much is going out the door every month on that?
$446 a month.
Hey folks, one of the big things I teach all the time is taking back control of your money. If you look at where all your money goes, seriously, take a second and write on a piece of paper where all your money goes. You'll see that your money's going a lot of the same places that Maureen's was. You're giving your good dollars away, and you need to keep those dollars. When credit cards are charging you 15, 20, 24% interest, all you need to do to build wealth is take that money back. This is the method you should use to do that. The money multiplier is exactly what you need. Okay, so now the other thing is we know if we paid all these debts off, if we got rid of every one of these debts, you'd be able to put $1,677 every single month back in your pocket. So that would be fun, but what would that be? A lot of times when we invest money, whether it's in stocks, bonds, mutual funds, ETFs, the traditional places people put money, we're always looking for a return on our investment, a rate of return. So what if we paid all these off? What kind of return would you actually be making on that money? Well, the easiest way to figure that out is to go and look at how much is Discover charging you per year in interest? How much is TD Ameritrade and Visa and Infinity? So let's go through that. Do you know the percentages that they're charging you on these loans?
Yes.
Oh boy. All right.
Discover is 24.24%. I wish I didn't know, but I do now.
All right. How about Ben's Discover? Same?
Same, 24.24.
All right. How about TD Ameritrade?
22.99.
All right. Visa?
22.99.
You ever think these credit card companies get together and kind of plan this stuff out?
I do.
Seems ironic. How about that Infinity car loan? That should be pretty low, right?
Yeah, that's at 2.39.
Much better. And then how about that Marriott Chase business card?
22.99. The common theme.
I think they're all secretly getting together and having a party. All right. So if we take the average of all of those and add them up, that's a 19.99% average rate of return you're giving away. Literally, that money's leaving your household every single month, and it's going to somebody else, not you. Would you be okay making 19.99% on that deferred comp investment that you've got?
Absolutely.
Would you like to make 19.99% on that savings account you got?
Absolutely.
All we need to do is change one thing and then take back all of this money that you're giving away, and that's the exact return. This is the part where a lot of people really struggle. I think they struggle because they think that making these returns involves taking a lot more risk. But really, if we just focus on where the money goes and how much of your money is going to somebody else, we can really start getting a picture of how easy it is to really take back the wealth or create new wealth, because it's right there. I would love to get a 19.99% return on any investment I did. And all I'd have to do is pay off these credit cards. Folks, it's that simple. Maureen, it's that simple. This is all we got to do. We got to get rid of this, create $1,677 every single month in your household, and we make 19.99%. I like this, man. I like where this is going. All right, so we got your debts. Now let's talk about your expenses. So tell me a little bit about the expenses that you have in your household.
My kids go to private school, so that's $13,000 a year.
$13K.
Each child, $13,000.
All right, so we've got $26,000 for the two younger ones, and then private school. So I'm going to write Lindsay separate, okay? Because I know she's going to college, so she's going to be graduating from school, not the other graduation. I mean the graduation from school here. So she's $13,000. And let's see, let's do the monthlies on that. So that means you got $21.66 a month going out the door there. Let's put 13 here again. All right, so the private schooling, so we've got 3 children going to private school, costing you about $39,000 a year or $3,250 a month if I do the math correctly. So now that we know that, what are some future expenses? Do we have any future expenses coming up?
College for Lindsay, is that what you're talking about?
Yeah, that's the one I was trying to scare you about a little bit. So
It does scare me.
So we've got college at, well, for 3 children times $22,000 a year. So that means we've got a college expense, roughly.
Oh, I don't want to see that number. Oh.
I know, I'm writing it, whether you like it or not. $176,000.
Wow.
All right, so we're gonna then talk a little bit about, do you have any other, what about household expenses? We didn't hit that one. How much is your household expenses?
My household is $8,840.56 a month.
Okay. So based on this, let's see. So one of the big goals we're going to do is we want to take this money back, okay? So that's number one priority. We want to make 19.99% on your money and not give it to them. We want to make sure that we cover this college number, because that's a big number. We want to make sure we can pay that off. Household expenses will come out of income. And then I think the private school, how are you funding that now? Is that coming out of savings? Is that coming out of any, or is it just coming out of income?
It's just coming out of income wherever we can find it.
Perfect. Hey, Maureen, I know this number looked like a big number to you, but I did the math wrong. So 22,000 times 3 kids is not 176.
Less?
Panel, how much is 3 times $22,000?
$264,000.
Oh my God.
Sorry. Yeah, when you're talking and writing and adding, it just sometimes you just miss a couple numbers. That's a big miss. Education is super important and it's extremely expensive. So it's not throwing money away, you're investing in your children's futures. And why not get all the money back for doing that by following this process? All right, we're going on to the next one. Here's what we basically do for you, Maureen. We built the plan for you, all right? So we went in and we designed your banking policy. Now, this banking policy, and let me ask you, when you first read the book or saw the video and you found out that this was a whole life insurance policy, what was your thought?
I really didn't know what to think, because I don't...
What do you think of when someone says whole life insurance policy?
Just, it's a death benefit, not a banking system.
Right. And that's what most people think. And I think the gurus out there, they say it's the worst investment on earth. And would you agree with that?
No, not at all anymore.
I do, though, because you know what? It's not an investment. So an investment involves risk. But you see, this system, this whole life insurance policy, and I want to be very clear, I know you know this, but everybody else doesn't. This is not your off-the-shelf whole life. This isn't you walking into the insurance store and buying a whole life from your financial advisor or your life insurance agent. This is specifically engineered and designed for banking, okay? So it's totally different. And because it's a whole life policy, it has one unique thing, and that is a guarantee. And people love guarantees. This thing is guaranteed to pay you no less than 4%. Okay, that's your guaranteed interest that you're going to earn on this little bugger right here. And not only does it pay you a guaranteed interest of 4%, that's why it's not an investment. That's why I love when I hear the gurus say, whole life insurance is the worst investment on earth. I agree. I'm like, yes, you're right. It's not an investment at all. It's guaranteed. I don't know too many other guaranteed places you can put money, maybe treasury bonds, maybe T-bills, and your savings account. But you already told me your savings account pays you 0. Okay, so even if you were earning 1%, you're still losing to inflation. So this is the plan design we put together for you. This plan design is built for your specific needs and goals. There's not one plan design that's the same. This one is very unique to what we're trying to do. Pay off your debts, pay for college, which is more of a longer term goal, get yourself a retirement house, and then buy some multifamilies. Those are your main goals. And I've got some news for you that we're going to get into later. You better start thinking of some bigger goals, because we're going to have, I think, a lot more money than what you're going to need just to solve those. But we're going to do it by using this boring, old, whole life insurance policy designed for banking. So that guaranteed 4%, that doesn't excite too many people. But every single year, these insurance companies, these are mutually owned insurance companies. Therefore, they pay a dividend. They share every single year the surplus assets that they don't use with their policyholders. So that dividend, I'll tell you in this plan right now, your dividend rate this year, going into 2021, okay, because we're almost done with 2020. We're going into 2021, your dividend is 2%. So this plan is going to make you a guaranteed 4% plus 2% dividend. That means you're making 6%. How do you feel about making 6% on your money?
I love it.
We spend extensive time looking at your needs and your goals. And you know, Maureen, I'd love to say we do this just for you because you're so special, but this is how we help every money multiplier client. Every single client that we work with, we understand your needs, your goals, your current situation, your current savings and income plan, and what we do is without changing any of that stuff, but we change one thing, and we change where that money goes. If you remember in the beginning, I said we're going to redirect some of those assets. Well, that's what we're going to do. We're going to redirect it, and in that redirect, we're going to literally pay off all your debts. We're going to fund all your kids' college tuitions at $22,000 a year. Then somewhere in the middle of there, we're going to buy yourself that house in Florida for $250,000. Heck, if you want to spend more than $250,000, be my guest. We got to have a number to plan for. And then after that, we're going to buy some multifamily rentals that are going to complement that pension and complement those retirement dollars that you've saved so diligently. Because really, I mean, you've worked most of your working life to save and to get all those assets built up. Now what we need to do is make sure that those assets don't disappear. We need to make sure that those assets continue to stay with your family so that you're not giving them away, you're not giving up control of them, and we protect them. And the other thing we're going to do, just as a little side project, is we're going to provide a legacy. Because like most people already know, a whole life insurance policy, they didn't know they could use it for banking like you didn't, but one thing they do now know is it's going to pay a death benefit upon your graduation. And by graduation, I mean the day you die. I just don't like saying die. So we're going to call it graduate. Fair enough?
Fair enough.
All right. So our team, our mapping team, went back and literally created a map. Now, because we have multiple goals going on, because we have multiple things happening all at the same time, this might be one of the most complicated maps that we've ever created. Because we literally have to have your money doing multiple things at the exact same time to solve your goals. But we put it together, and it's a lot of numbers. I want to prepare you for that. It's a lot of numbers, but you don't have to do any of those numbers. All you have to do in this process is decide to change one thing, and you already did that, which is how we're going to arrive at these numbers. We do all this work. We don't charge you anything for it. You're never going to write a check to Chris Naugle. You're never going to write a check to the Money Multiplier. You're just going to make deposits into your new infinite banking policy to solve your problems. Fair enough? All right, Maureen, so here's one of the tools that we create for you. So we do several tools with our mapping team. Our mapping team puts together a cash flow tool. We also put together a map, which is very amazing for you. I can't wait to get into that. But let's talk a little bit about this right here. This is your cash flow. So this is where we actually take all the numbers from the insurance company's illustration. We actually show you how much money you're going to have each year. And you know, the most important thing about the cash flow is that we see where does your plan actually break even. And what I mean by break even is, you know, the fun part where if you deposit, because we're putting $50,000 into your plan for the first 10 years. Okay, this is just your plan. We also built plans for all of your children so that we can fund their college. But the break-even point is the point at which where you're putting money in, you actually get more than what you put in. Now, one of the things a lot of people seem to want to really hone in on the infinite banking concept is they always want to say, yeah, but if I put my money in a savings account, I'd have access to all of that money. Totally understand that, right? Because in this one, if you put $50,000 in, you only have access in the first year to $30,193. Okay, it's roughly about 60%. So we have access to roughly about 60% of that money. But the cool thing is that $50,000 that we deposited, remember, that's earning 4% plus dividends. So you're earning 6% as of 2021 with this company, okay, with the new dividend scales. So if you put 50 in this plan and you take out 30,193, which is your cash flow, which is why we do this, you're still earning interest and dividends on the full 50. So if I asked you, would you rather have access to all 50,000 and earn nothing, or would you rather have access to 30,000 and earn interest and dividends on 100%?
100%.
All right, so you want the interest and dividends. So then the most important part is at what point are we able to take out more than what we put in? This is my favorite part, and this is the worst case scenario that we're going to look at. This cash flow shows your guaranteed values, which remember guaranteed is just the 4%, okay? But never once in history, 168 years for the company that we're doing this with, never once have they not paid a dividend. So if I use your guaranteed column, I'm literally saying that something is going to happen that hasn't happened in 168 years. So we don't usually use the guaranteed column, but we do show it because we want you to see no matter what, if all you ever earned was 4%, this is how much money you're going to have. But we want to use the projected cash flow, which is a projection of today's dividend. And the nicest thing about this dividend, I don't know if you know this, but this dividend that we get on this plan is the lowest it's ever been in 30 years. So for 30 years with this insurance company, this is the lowest dividend they've ever paid. So I'd like to say that in the future, it might be likely that dividends would go up, but we're not going to do that. All we're going to do is look at today's dividend. So where does your plan actually break even? Well, if year 2 we put in 50, we have 32. Not so good. A lot of people don't get excited about that. But year 3 you put in 50 and now you have 49,335. And if you never took money out for 3 years, you'd have 111,675. You see, we're keeping track of how much cumulative cash value you have, but we're also keeping track of how much cash flow you have, because here's why. We want every year to use whatever your projected cash flow is. Because we know if we keep the money in there, you're going to earn 6% with dividend. But if we take all the money out, you're still going to earn 6% with the interest and dividends. So why would you leave the money in when you can take it out and earn the same amount? Well, the insurance company, when you take money out, they do charge you interest, 5% simple interest. So here's the cool thing. Remember that savings account that you said you earned nothing on? So if the insurance company charges you 6, but if you are getting paid 6, and the insurance company is taking 5% simple interest, how much did you make? You made 1%, right? In the very first year, you made 1% on your money if you took all of your money out, if you could. Your bank account doesn't even pay you 1%. And here, if it was allowed, you could take all that money out and never, ever have to worry about not making money. That's the beauty of uninterrupted compound interest, but it gets even better. And we're going to show you what uninterrupted compound interest looks like. But right here, so year 4, you put in 50,000 and you have 51,829 to take out. What do you think of that?
I like it.
Okay, but let's go forward. How about year 10? Year 10, you put in 50,000, and in year 10, you have 69,861 you can take out. Now, is that a pretty good return on your money? We're going to look at returns later in a little bit later in this tool, but like the thing I love most about this, it doesn't matter where we go. So year 15, you put in 20, and year 15, you have 54,000. So in other words, you give me 20 grand, I give you 54 back. Who's winning in that game? Folks, this is the power of uninterrupted compound interest. Maureen, this is why we do this. Yes, do we give up a little access to money in the first couple of years? We do, but look at what we get. And I'm going to show you how this thing works. We put in 700,000 over 25 years, you got 1.4 million. And if for some reason, and we never talk about this because we don't build these for that death benefit, that graduation date, but if that ever happened, it's not going to be such a bad thing, because if something happened to you, you got hit by a bus, I always call that the bus fund, about $1 million and $1,030,000 would be paid out immediately. But as we keep going, that number goes up. So if in the 10th year you got hit by a bus, 1.8 million gets paid to your beneficiaries tax-free. You see, we're not only covering you and giving you access to use your money while you're living, but we also give you money if something happens and you graduate that goes to your family. So we're providing a legacy, which we don't ever talk about, but I wanted to make sure that we made that very clear that you do have a legacy. So all we did here is we basically do these cash flows just to show you how much money you have every single year. So folks, I'm sure you're looking at these cash-on-cash returns going, wow, that's impressive. But you know what's even more impressive? Not having to pay tax on the internal buildup of the cash value. Now that's even more impressive. So if you really dive into why this has been a secret of the wealthy, there is no tax on the gains if done properly. So folks, check with your CPA, but these plans can provide tax-free income. All right, so Maureen, one of the other things we did is we designed a plan for each of your children to fund their college, because that's a really important thing. So we just took the money that you used to put away into the 529, and we just shifted that 529 money over to the kids' college savings plans. So we've got the plan for Alexander, we've got the plan for Connor. These are all the same, so we're putting $5,000 in for the first 10 years, and then after that, it's going to drop to $2,000 because of some rules. The IRS has specific rules where we can't put money in past a certain point in time because it's called the MEC 7 pay. We're not really going to cover that, but that's how we design these. We design them solely to basically be able to put money in and take money right out for their college. Because one of the things too, I think a lot of people don't understand about the way we build these whole life policies is when you make a deposit into these plans, whether it's your plan or the kids' plans, we have access to that money immediately. Immediately in the first 30 days, we can put money in and take money out. For example, if we put $5,000 in Alexander's policy, how much can we take out? We can take out $32.13 immediately, okay? We have access to this money, and that's the beautiful thing, because I'm always talking about controlling your money. You have to have control, and in control comes liquidity. You need access to the money. So we give you that full access. Now, let's just take a look at these ones, because these are smaller plans. Where do these plans break even? So if we put $5,000 in, it's the same thing. So right here, year 4, we put $5,000 in, and you have $5,084. So it took 4 years to have more money than what you deposit going forward. The 5th year you put 5 in, you get 52. If we go down to the 10th year, you put 5 in, you got 66. I mean, these returns start getting nutty. 15th year, you put 2,000 in. I don't know, you get $5,000. You put 2 in, take 5,007 out. And again, what you're also doing for the kids is even though you're the owner of these plans, they're the insured, so therefore you control the money, but if anything ever happened or down the line, let's say they go off and they have children and they've got their own families, they've got a life insurance death benefit attached. So again, we're fixing that legacy piece, plus we're giving access to cash. Remember I said the other thing too earlier, when we pay off all your debts, which is the next tool, the map, we're going to show you how we do that. Remember, there's 19% we're going to pick up right there, but how much money does the vehicle all in itself, this specially designed and engineered whole life, what does that make you? Well, we put together this sheet here, which we call our cash-on-cash returns or our cash flow returns. So how I do this is we break these down in 5-year blocks. Okay, so in the 5th year or 5-year breakdown, your cash-on-cash return, your cash-on-cash return on that $50,000 is 8.89%. So remember earlier we talked about this is where people get screwed up all the time. You're guaranteed to get 4% plus a dividend. And if that dividend this year is 2%, you're making 6%. So people never really fully understand uninterrupted compound interest. They don't understand the power of compounding. Albert Einstein did. He called it the 8th wonder of the world. Those that understand it earn it. Those that don't pay it. Have you ever heard that with Albert Einstein?
I have. I have heard you say it.
Over and over and over again, like a broken record. But this is why, because if all you're making is 6%, how the heck can you make 8.89? That's only the 5th year. How about the 10th year? You put in 50, and based on your cash flow that you have, that's a 39.72% cash-on-cash return. And a lot of people get hung up because there's actual returns, there's compound, interest returns, and then there's the cumulative return, which is where you would take every penny that you put in, add them up, and then figure out what your return is. That would be lower than this. But that would require us to put the money into this whole life and leave it sit and never use it. That's not what we're going to do. We're literally going to take your money, put it in, and immediately take it out and use it to make more money. That's what the infinite banking concept does. And that's what the money multiplier is all about. But here, what we're doing is we're looking at the return the same way you will look at your returns in real estate. Whatever money you put in that year, how much did that money grow to? For example, if we deposit $50,000 in the 5th year, you make 8.89%. If you deposit money in the 10th year in your plan, $50,000, you make 39.72% on that $50,000 deposit. And then all we're going to do is we're just going to take that return, we're going to take that money right out. That money is going to come out, that money is going to come out, and you're still going to make the same return because no matter what, they're going to pay you that 6%. If dividends remain constant where they're at now, they're going to pay you that on the full 50 grand that you put in that year, even if you take it all out. And that just keeps getting better because by the 15th year, how about 171%? That's not such a
Oh
bad
my
return.
gosh.
How about this one? 20th year, okay? I know it seems like a long time in the future, but what the heck? 20 years, 254% cash on cash return.
I like it.
Even if we look at the guaranteed returns, like the guaranteed, only the 4%, forget about the dividend. You know, everything's going to change. After 168 years, the insurance company's never going to pay you another dividend for as long as you live. Darn it. So how much do you make? Well, the 5th year you would have lost money because there would be no dividend. But the 10th year you made 14.45. The 15th year you made 60%. And the 20th year you made 71%. That doesn't suck. That's pretty awesome. And the same thing for your kids. So we got Alexander, Connor, Lindsay, and then I'm going to show you combined, which is even better. But their returns are similar. 5%, 33%, 150%, 246 cash on cash. And it's very much the same for all the kids. But if we look at a combined plan, right? If we look at where you're putting money now, and then we just change that one thing and put it into these specially designed whole lives, and we took them as a combined, that means you'd be putting $65,000 into the plans. By the 5th year, you made 8.48. The 10th year, that 65 you put in, you made 38%. The 15th year, which is the magic, actually every year after the 10th year it gets crazy because now you can't put 65 in. You can only put 26,000 into the plan. So 26,000 is the max amount you can fund this plan at. And at that point, you made 168% cash on cash. And in the 20th year, 26,000 goes in, you make 254.86. That's your cash on cash returns. I mean, I can't even make these numbers up, but this is right off of the insurance company's illustration that they provide. Pretty impressive,
Wow.
right?
Oh my, yes.
So when you read the book, did you ever think that you could make these kind of returns on your money?
Never. No, never.
Now that we've kind of got excited about how the plans work and the plan designs and how just the plan operates, let's get into the best part, which is actually solving your money problems. Let's pay those debts off. Let's pay for those college tuitions. Let's buy that house in Florida, and then let's look at buying some passive income. So we're going to now go into the final and last tool that we create, which is called the map. And this is where our mapping department really sets apart the money multiplier, because this is the one thing we do different than everybody else. So let's dive right in. All right, Maureen, this is the part where all of the work that we've done up to this point all comes together and literally puts you at ease and solves your money problems. And like I've probably never been so excited to show this than I am right now, because this one was monumental. Because the hard part about this map is, if you remember back everything we talked about, we have two things happening at the same time. So we're paying your debt down, but Lindsay's going to school. So we literally needed to not just create one map, we needed to create two maps for you. One showing your debt pay down, and then we needed to capture all those numbers, and then we needed to show those numbers applied toward college. So it was very difficult in creating this, but this is what we do for our clients. This is what the mapping team is good at. And the best part about this is, I know we've kind of gotten deep into the numbers the last few that we've talked about, from the cash flow. It's all numbers. We do all this for you. I mean, all you had to do is tell us what your problem was, and then we solve that money problem. That's the only thing you had to basically do, is just give us the inputs, tell us how much you want to put into these vehicles, that changing one thing, and then everything else takes its place. So I just want to do a quick recap, because we've talked about a lot of things. And if everybody remembers, in the beginning, we had technically four major goals. Number one, we wanted to pay debts down. I'm going to show right here in this map exactly how we pay Maureen's debts down. Then the second goal was we wanted to pay off all the college, which is 3 kids at $22,000 each year in college expenses. So we're going to get into that right after we pay the debts down. And then after that, we're going to basically allow Maureen get her really excited, because she gets to go buy her house in Florida. And then also, pretty much, she's going to have a lot of extra money that she can go buy some passive income rentals with. But the other thing too I want to remind everybody is, when you're seeing these numbers, and we're talking about 50,000, deposits going in here, and then we're talking about the $5,000 deposits going into the kids' accounts. All that money, that's not newfound money. Maureen, did you have to work any harder to do any of this?
No.
Did you have to work longer?
No.
Okay. Are we taking on any risk with doing this?
No.
And did you lose control of your money?
No.
So we didn't lose control. We didn't take on risk. We didn't work any harder. All we did is we just repositioned where her money was already going. And folks, whether it's $50,000 or $500 a month, it doesn't matter. Your numbers are your numbers. Maureen numbers are her numbers. And these are the numbers she was saving prior to meeting us and prior to reading the book, Mapping Out the Millionaire Mystery. So let's really go into it. And I'm going to go slow here because there's a lot of numbers and I want you all to really digest how simple this really is, because all we're doing is we're taking all of her debts, we're putting them in a very specific order. We call that snowballing. And then what we're going to do is we're going to basically use velocity, the money that she's giving away to these credit cards and these car finance companies, and we're going to take that money back. And I'm going to show you how this works. Over here, this is your deposit, okay? We put $50,000 in the first year, which was just money that she had in her savings account and money she was already putting into retirement accounts. So we did that. Now, out of that, she has available from the cash flow model that we did, $30,193. So I'm just going to write that down here. So we've got $30,193 available immediately. What we're going to do is we're going to take that $30,193, and what we're going to do is we got to have that money do two different jobs. Number one, that money is going to be used to pay off some debts. But number two, a portion of that money has to be shifted over to the college planning portion to pay for Lindsay's school, because that was part of the deal, right? We have to solve that college goal. So $8,906 of the $30,193 is going to go off to pay for Lindsay's college. So I want everybody to understand that we're doing two things with the same dollars. But we are going to use $21,287, which is right here. Total funds available to use. This came right from the cash flow tool that we built for you, Maureen. So what we're going to do is first, we're going to pay off Discover. Now, I know it's been a bit, but Discover, we owed $2,245. You were paying $200 every single month to Discover at a rate of 24.24% interest. And roughly, it would have taken you 13 months paying $200 to pay that debt off. 13 months to pay just one of these credit cards off doing what you were doing before. So now what we did is immediately, the second you make this deposit, we're going to pay Discover off. But what we're not going to do is we're not going to pay Discover off and get all excited and be like, yes, I won. No, we're going to take the $200 you were giving to Discover right here, and every single month, we're going to change who that $200 goes to. We're not going to pay that $200 to Discover anymore because we paid them off. We're going to take that money that we were giving away, that 24.24% interest money we were giving away. I just wanted to rub that in, push that knife in and twist it a little bit. We're going to take that $200 and we're going to put it over into a newly created bank account. So all you're going to do, Maureen, is you're going to go to your bank and you're going to open a brand new checking account. Nothing fancy about it. Don't even need checks. You don't need a debit card. The only thing we want is a holding tank to put the money that you're giving away into. So every month you would set up, how I do it, and I think how you should do it, is set up a bill pay. Instead of paying to Discover, pay that bill pay back to this segregated bank account. That's it, okay? Now all of a sudden it's out of sight, it's out of mind, and no new money had to be created. But we're also going to take this $22,287 and we're going to pay off TD Ameritrade. TD Ameritrade credit card was $3,351, and you were paying 22.99% interest on that one. 22.99%. So with this money, we're going to pay off TD Ameritrade. So this one's gone, okay? So we get rid of that one, we get rid of Discover, but now you were giving them $149 every single month. So we're going to take that $149 and we're going to move that money through a bill pay or an automatic transfer into that newly created segregated account. So $149 goes to that bank account. Also, this $21,000 was enough to pay off your Chase card, and it was also enough to pay off Ben's Discover card. So what was the impact of paying those off? Well, number one, you were giving $214 a month to Chase, and it would have taken you 40 months just to pay off Chase if you continued on the plan that the credit card set up. See, that's the funny thing. The credit card companies want you to keep paying them. They make those minimum monthly payments super low so that everybody can afford them because that's how they make money. You're just giving them interest every month. Why wouldn't anyone want 24 point, or what is it? Yeah, 22.99 or 24.24. Why wouldn't someone want that monthly payment coming in? So that's all you were doing is paying the, pretty close to the minimum. And because of that, it would take 40 months. Now Chase is gone, and now you've got $214 freed up that you used to give away. We're just going to take that, and we're just going to take that $214 and put it over here into this segregated account. Same thing with Ben's Discover. Pay that off, free up 24.24%. That frees up $200 a month. That goes over here. So you'll notice over in this column, okay, right here, $532 every single month is the amount you were giving away to these different companies, okay? It's actually it's actually more than that. $763. So $763 a month is what you just freed up in that first year that you were giving away to everybody else. We're just going to change that and put that over to that segregated bank account. So now all that's left is you've got a car loan, but we have some extra money. We didn't spend all of this money that you had available from that loan we took from the insurance company. So what we did is we pay the car loan down from $14,000 down to $11,000. So in 1 year, without changing anything, so what we've done is pay off all of these credit cards. The only thing left is your car loan and your business. And if you remember, this is your business loan, that business credit card from Marriott Chase. Those are the only two things left after the first year. What questions do you have for me in regards to what we've done so far?
I don't know, but I love what you're doing.
All right, Maureen, in the first year, we paid off all these credit cards, and all these credit cards that you were giving money to every single month, we've just added all that up, and all we did is we put it into your segregated account. So we got $763 a month, every month being now put into your account, not the credit card company's accounts. So at the end of the year, you would basically have saved $9,156. That's $9,156 you used to give away to the credit cards that is now in your bank account. I mean, like, do you want $9,000? I'll take it if you don't want it.
No, I'll take it.
You want that?
Yeah, I'll take it.
All right, fine. Okay, so the only things left going into year two, as I said, is the car loan. We've got about $11,338 left because we did pay down a little bit of that car. But when you pay down a credit card a little bit, it reduces your monthly payment. But a car loan is an amortized loan. So therefore, when we pay it down, your monthly payment doesn't change. So in year two, all we've got are these two things. Let's go over to year two here. The second year, all you're going to do is the same as first year. You're going to deposit $50,000 into your banking policy. Okay, that specially designed whole life, that's right here. And now in year two, you have $32,000 to use. The first year was only $30,193, so year two, it's a little bit more. Okay, now what we have to do is we have to send that money to work in two different places. Obviously, one part, the $24,786 right here. Okay, $24,786, just so you understand exactly what that is. That is the portion of this $32,000 that's available to you, plus the segregated bank account that all you did is you changed where the money went. That was $763 a month. That's $9,156. So $9,156 plus the amount of the cash value that we used makes up $24,000 here. The other $16,517, that money is going over to the other map to pay for Lindsay's college because we still have that obligation. We've got two things we're trying to do at the exact same time. But this is where it starts getting really fun. You see, we take this $24,000 that we have, which is the amount of the segregated account plus the amount available in your cash value, and we pay off this car. So the car loan is now gone. So that Infiniti that you drive around, you pay $468 a month. Even though that $468 is only 2.39% interest, would your car feel and drive better if you didn't have a monthly car payment?
To me, it would.
It's kind of a trick question. It would drive the same, but it would feel a lot better not having to make that payment. But you see, you're not going to not make that payment. All right, so now that the car is paid off, $468 a month now can get put into your segregated account. But now we got this business credit card, okay? And I know you like to keep your personal and your business separate, but we're going to use your banking policy to pay off this business credit card because you're giving them 22.9% interest, and we can't do that. And you're giving them $446 a month, and it would take 53 months to pay that off based on the credit card company's plan. Well, this is your new plan because we're not going to have that take 53. We're going to pay it off, get rid of Marriott, free up $446, and take that money over here. Now, as a bonus round, one thing you could do, because this is a business, you could actually lend the $14,774 to your LLC. Okay, you could do a loan to your LLC for $14,774. Charge your LLC 6%, because why not? I mean, you could pick whatever interest rate you want. You're the bank. You own the money. If you're giving the money to your business, charge your business interest. Then that business then pays you back with interest instead of you having to pay yourself back. Just an idea. I just wanted to kind of give that because that's another option, another way you could make some extra money if you so choose. But here, all I'm trying to do is get rid of all the debts. So by doing this, it's taken us, well, a lot less than 2 years, but I'm just going to say at the end of the second year, what is the result? The result is now you took back all $1,677. That was $1,677 that early on when we went through all your expenses and your debts, that was that money you were giving away to everybody else. And that was at a rate of 19.99% average. So you literally now are making an average 19.99% on all of this money that you just took back. So after the end of year 2, 24 months in, your segregated account has $20,124. Now we're going to look at the impact of that later because what we did as a bonus, we showed you exactly how much interest you're going to save on this entire thing. But at the end of the second year, you got an extra $20,124. That's literally wealth that you created just by taking back the money that you were giving away. So this is your debt map. As we keep going with this, these segregated accounts, okay, will keep having this money going in there for the same amount of time that you would have given it to the credit cards. 140 or 40 months, 13 months, 64 months, 31 months on the car loan, and 53 months. That's how long you were willing to pay somebody else. So since you were willing to pay somebody else a monthly payment for X amount of time, you should pay yourself back the exact same amount for the exact same amount of time you were willing to give it to them. Because you're an honest banker now. This is your bank, meaning this is your money. And if you owned the bank, well, you wouldn't steal from your bank. You'd be an honest banker and you would treat your money the same way you treat the bank's money. That's all we're doing here. We literally did nothing different other than follow a process, change one thing, and then take back the money that you were giving away to everybody else because you're just treating your money the same way you used to treat the bank's money. Because what would happen if you didn't make that $468 a month payment to the Infinity car loan?
They'd repo my car.
Right. So if you don't pay $468 a month to your bank, well, I guess you could go repo your car. It's kind of the same as keeping the car in the driveway, but it sounds cool. So Maureen, now that we've got the debt map done, now we have to kind of almost go back and look at the second map, which is going to be your college plan, and the map showing how we're going to pay off all the college, because you see how much you just freed up here. We're going to use these dollars and play double duty with these dollars over on the college. So let's pull that map up. All right, so here we are. This is the final map. This is the college map. This is where we actually pay off every one of your children's college, and we do it with a lot of extra money because all we're doing is we're just using velocity to keep that money moving, and not only that, we've still got all the money moving from when we paid off your debts. So here's how this one works. So now when we first set up your plans, we set up a plan for you, a plan for each of your children, okay? So the plans that were set up for your children was nothing more than just reallocating the money from the 529. But if you remember in the beginning, we still had money left over in those 529 plans. So those 529 plans that you had set up, we still have that money, and that money is still available. We're going to use that. We just didn't put any additional money in there. So starting with the first child. So we got Lindsay. She's 17. She's in school pretty much when? In the fall she starts, I believe?
September, yep.
In September. So Lindsay, when she goes to school, she's got a college tuition of roughly $22,000. That's how much money her college is going to cost each year for about 4 years. But what we had to first do is we had to figure out what would it cost to get financial aid for this? How much would it cost if you got a student loan for Lindsay? Well, if we got a student loan for Lindsay, what we found is the average right now is about 4%. And if you did a 4% loan, it would roughly work out to be about 180 months before that financial loan was paid off, that student loan. So here's what we're going to do. The first thing we're going to start with, and remember, we've got 529s for each of the children. We've got policies, these specially designed and engineered whole lives for each of the children. So what we're going to do for Lindsay is we're going to take $10,000, which is the amount that's in her 529 plan, and we're going to take that $10,000 and we're going to apply that to her college tuition that year. So now we got to find the rest. So where's the rest of the money come from? Well, if you remember, in the very first year in your policy, we took $8,906 of your cash value and we allocated it toward the college. So we're going to take this $8,906 plus the $529, plus we're going to use Lindsay's cash value, which is $3,094. If you add all three of them up, that takes care of year one of Lindsay's schooling. But what we're going to do then is we're going to recapture, once we pay for that college, we're going to recapture the $185 that you would have given away for a student loan. So we're just going to take that $185 and we're going to move that $185 over here into a segregated bank account, just like we did before. So really, remember, for your debts, we had a segregated account. For this, we're going to have a segregated account. Might as well have two separate accounts to keep these tracked separately. So year one's done. But at the end of year one, that segregated account has grown to $2,219. That's nothing different than the money you would have given away for the college financial aid or the college student loan, whichever you choose. That would have been money given to somebody else that we're going to recapture over here. Okay, so now going to year two for Lindsay's college tuition. So Maureen, now we did year one, year two's up. So now we've got another $22,000 of college tuition that we have to pay for Lindsay's second year of college. So it's simple. How we're going to do that, we already used the 529, so we have no more money left in the 529. But what we've got is we now have $3,264 in Lindsay's cash value from Lindsay's specially designed and engineered whole life. We also have $16,517 in your cash value in your plan. Plus, remember, we recaptured that $185 the first year. Okay, that was money that you would have given away to somebody else. We just put it in your bank account. That's all we literally did. We created a new segregated bank account and put $185 in. So if we take that segregated account plus Lindsay's cash value plus your cash value, there's year two. Lindsay's year two college tuition is covered. Now, here's what we did not do in year two. In year two, we didn't touch Alexander's cash value. We didn't touch Alexander's 529, and we also didn't touch Connor's 529 or Connor's cash value. But their cash values are growing. So as you'll see here, what we're going to start tracking now past year two is we're going to start rolling over cash value year after year, so we can keep tabs of how much money you're actually building in these other plans that we're not using yet because they're not in college yet. So with that, that takes care of year two for Lindsay. We pretty much paid everything off for the college. We recaptured another $185, so now our segregated account every month has $370 a month going into it. Again, that's not new money. It's money you would have given away to a student loan or to some other loan that you would have had to take out. And now that has $4,438. So now we move on to year three. Okay, I know you're probably getting tired of seeing numbers and you probably have your eyes rolling back in your head, but just stop and listen. We create these maps for you. All you have to do is follow what we create. And the other thing that's important is, remember, it's very simple. We're taking money that we put in your left hand, we're moving it over to the right, which is your money problems, and then we're taking money you would have given away to somebody else and we're moving it back into your account instead of giving it away to someone else. That's all we're doing. Check it out. All right, Maureen, so year three of Lindsay's college. So again, assuming $22,000. Now, the only thing we're not taking into account here, and someone is going to watch this and say, yeah, but every year college goes up. We're just keeping it static. We don't know if college costs are going to go up, so we just keep it the same at $22,000. So if you remember what happened the prior couple of years, we used the cash value from your policy the cash value from Lindsay's policy. The first year we used the 529 plan, okay, which was the original college savings plan you did. But now something very unique happens. You see, now that velocity starts picking up, and now we start running into another problem, and that's where you have a lot of extra money that we're not going to use. That's not a problem a lot of people get to deal with, but it's a problem you're going to have to deal with, and I'm going to show it to you in just a second. You see, we pay the $22,000, but we don't even have to touch the cash values in your plans, because all we're going to do is we're going to take the $4,438 that was saved in that secondary segregated bank account. That was just money you would have paid to somebody else, okay? But you remember, we paid all your other debts off. All your credit cards got paid off in year one and maybe a couple months of year two. All that money didn't disappear. So what we're going to do is we're going to show that debt right here. So this is your segregated account from your debts, and this is your segregated account from the college. So if we look at both of those, literally in this year, year three, $20,000 plus $4,000, you have enough money to pay for Lindsay's college just from the segregated accounts, which is just the recaptured money you used to give away to somebody else. So now I would look at this and I would say, you're paying for Lindsay's school with money that you used to just give away to all the credit cards, the money you used to give away to Infinity for that car loan, and the money that you would have given away to financial aid or some student loan that you would have taken out to pay for her college. So, but we had more money than we needed. You had $24,438. So what we do here, and you're going to start seeing this as we go on, we're going to start rolling over money from the previous years. Because prior, we had just cash values and just monies rolled over from the other two kids. But now what you're going to see is as we go into year four, we're going to roll over the difference that we didn't use, which is right here, okay, $2,562. Plus, we never even touched your cash value, which is now $47,000. So now you got 47 grand sitting in your banking policy. You've got $4,737 in Lindsay's banking policy. Nope, we didn't even use that. And then you've got the other two boys, Alexander and Connor's cash. So that's $11,000 and $11,000. You're starting to build up an awful lot of money. And now all of a sudden, we're not even using these vehicles to pay for school. So that's going to be something you're going to see later. That's the money that you're going to basically use to fund your other goals. One other thing we didn't talk about with Maureen is as she gets this rolling, she's going to have a lot of extra money, and she's going to want to put that money back into these specially designed and engineered whole life policies. But she can't because of IRS guidelines. But you remember her husband, Benjamin? That might be the next person that we start the banking policy on. So when you start your banking system, think, who do you want to start a banking policy on? Is it you, your spouse, your children? How about the whole family? It's time to get into privatized banking, folks. Change your life. But the good thing to notice here is we're starting to really pick up some steam here. All your planning, all the velocity is really starting to work in your favor, and all we're trying to do is pay for college. All right, so we're continuing on. Nothing's really changing. We're just flowing through this. So now we're in year four. Now, some people that are watching this, and Maureen, hopefully it's not you, your eyes start to roll back in your head. My cameraman's eyes are rolling back in his head because there's a lot of numbers. This is a lot of math. Isn't it nice that you don't have to do this, Maureen?
It's wonderful.
See, this is the thing that I try to help people understand is we do all this work. We're the ones that did all the math. We're the ones that did all the calculations. All you did is told us what you want, and we're just solving your money problems. Like, if everything was this easy, every single person would be wealthy. Unfortunately, I can only help the 5%ers that want help. So another thing happens here in year four that I think is really important to bring about. There's almost like a double effect going on here because now instead of just having Lindsay in school, we now have Lindsay and Alexander in school. For most families going through, funding their children's college, this is like the Iron Cross. This is like, oh my God, we can't do this. But this is where yours starts to get easier. This is where you start just running into a problem where you just have more and more money every year. But it should be just the opposite. Most people struggle when they have two children in college getting funded, but now you don't because we've done the planning. So here we've got Lindsay in school at $22,000, but now Alexander enters school at $22,000. And remember, all we did is we looked at and we ran an amortization on how much would a college education loan cost. and it was 4% over 180 months. So we've got 2 kids in school, $44,000. So how are we going to pay for this? Well, now, because Alexander entered school, we want to use up that tax-free 529 money that you saved back a while ago. So we're going to use $8,000 for Alexander's college, and that's $8,000 from his 529. But then what we're going to do is we're just going to come over here. Do you remember all those debts that we paid off? That money you used to give away to everybody else? All you did is you're now just taking that money back. You're keeping the money you used to give away, and that works out to be $30,756. We got $30,000 in that segregated debt account that we created, but then we also have $6,657 in that college segregated account where we were recapturing the $185 per year for college. That's it. So you don't even need all that money to fund. You needed 44 grand. 8 plus 30 plus 66 gives you an extra $1,400 that you didn't need to use of money that you've already set aside. But it gets even better because not only do you have that money, we've got a total cash value amongst all the plans. Your plan, Lindsay's plan, Alexander's plan, and Connor's plan. You have $64,168 in cash value, earning interest plus dividends that we don't even need. So what we're going to do is we're going to show that money rolling over into the next year. So now your cash value in your plan is now $95,000. Then Lindsay's is 12, Alexander's is 16, and Connor's is 16. All that money is money we didn't need. Money that just rolls over to the next year for whatever it is we're going to do. So, you know, how you could really look at that is, I know we're using this to pay for college, but let's say Lindsay comes, Mom, I need a car. Like, I'm sick of asking people to drive me around. I don't want to take those Ubers anymore. Like, this COVID thing scares me. Do you have enough money to buy her a car? Well, you sure do. I mean, unless you buy a car that's more than, I think in this year, $12,000, you could use this to fund a car now. You didn't just pay for her college, but now, heck, you had money to pay for her car. You had money to pay for her college housing or whatever it is. You see, like, having extra money is really never a problem. And I mean, if you got a problem with any of the extra money, I can tell you where to send it. In year 5, we've got Alexander in school. We've got Connor in school, both at $22,000 each. Now, because this is Connor's first year, we had $8,000 in the 529 plan. So we're going to use that 529 plan. So now all 529 funds are exhausted. Okay? The second thing we're going to go over and use is we're going to use the money in the segregated account. So we're going to use this $10,000 in the segregated account, which was from the debts. Now you'll notice that that segregated account amount has come down. And the reason for that is we're starting to pay off debts. So when we do these segregated accounts, the way we track it and the way we map it for you is we're not going to continue paying the equivalent of the Infinity car loan if really you would have been paid off on that car. So we cut off some of the debts when they actually would have paid off. So therefore, this debt account, as you can see, pretty much starts going to zero here soon because we're using all that money up, and then we're not going to keep saving that debt money. It's just going to be money that's really in your household, which is kind of cool. We also used the $11,095, which was the segregated account for college. So now we've got most of the money used, or most of the money we need for the college, except for now what we're going to do is we're going to come over to some of this money that's been just every year rolling over. We're going to use that rollover money from the debts. We're going to use Lindsay's remaining rollover amount from her policy, and then we're going to use a little bit from Maureen's policy to basically pay for college this year. Okay, so you see a lot of things happening here. We're paying off a lot of college. We're using money from multiple different accounts. We tracked all this for you, but you know, here we are, we're in year 5, and we're gonna fast forward a little bit because the same thing happens over and over again. All we're doing is taking money from these specially designed and engineered whole lives and paying for these college loans and paying off her college and everything else. So don't get hung up on the numbers, just understand we built the process, you just have to follow it. And as we keep doing this, this is going to be the flow. This will be the flow in year 6. This will be the flow in year 7. This will be the flow in year 8. And all we're going to do is we're basically just going to change where the money is going. It's all the same dollars. It's the same routine. We're tracking it. All you need to do, Maureen, is really just follow this map that we give you. So literally every year when we tell you take money from here, take money from here, you just follow the map. That's all you got to do. It'd be much like you get in your car and you punch in the address for the place you want to go into your GPS. You don't really have to think about where to go. You just follow the instructions. Turn right, turn left, go straight for 2 miles. This is kind of the same thing. I know there's a ton of numbers and a lot of people get lost in the numbers, but that's not what this is designed. This is designed to take the numbers out of your hands so you don't have to deal with it, and all you need to do is just follow the map, follow the GPS. And the result of that, if Andrew scrolls down a little bit here, what'll end up happening is by year 8, something really cool starts happening. Now in year 8, we're pretty much done with school. We've got a couple more years, so Connor's got his 4th year, but now we get into the fun stuff. No more college after that. So here, college is going to be done after that, and we have more than enough money to keep funding college. As you can see, your rollover just from Maureen's policy is $252,000. Connor's got $32,000, which he doesn't need $32,000. He needs $22,000. So if we've got $252,000, what are you going to do with $252,000, Maureen?
I'm going to buy my retirement house.
And here we go. So now we're going to buy a retirement house, and that retirement house is going to cost $250,000. Now the other thing too that we've been doing this whole time is as we've taken money from these life insurance plans, we've been taking loans, which is why the insurance company continues to pay you interest and dividends, because you haven't taken your money out. So all this money we've taken from all these policies, it wasn't your money. Your money stayed in your account. We took loans from the insurance company, and those loans don't really have to be paid back because they're just going to be subtracted from the death benefit. Here, what we're doing is we're buying yourself your retirement house for $250,000. And all we did is we said if you took a $250,000 mortgage from the bank at a low interest rate of 4% over 360 months, if you wanted to, this is up to you, you could then recapture $1,912. It's kind of silly because we've already created $1,912 in your budget already, because you no longer are paying any of those debts. So this is just found money, found wealth that you created, and now you've got that retirement house. So you could recapture those dollars, which we would suggest, and that's how we mapped it, but really you're the bank. Do you want to be an honest banker, or do you just want to say, you know what, I've earned this house, and I don't want to recapture the money? That's up to you when you get there. But the short answer to everything here is we're only 8 years in, and in 8 years you're completely debt-free. All your children are now, except for one more college year for Connor, all your children are through college. You've got your retirement house over there in Florida, and now all we need to do is really just say, how much more money do you need to buy some rentals? And that's pretty easy to do, because now the plans will keep building on themselves. They will keep creating cash value, no matter whether or not you use it all every year or not. This is solving your money problems. That's how we do it. It's a lot of numbers, but end result is what you wanted. What are your thoughts?
I love it. Thank you.
All right, Maureen, so it's exhausting, but we got through it all, and now we're at the part where I just get to show you, like, what did all this mean? Now I know we paid off all your debts. I know we got rid of all the college, and college is out of the way, paid for. I know you got your retirement house, and now you can start buying some of those passive income rentals because there's more than enough money to do that. But really, at the end of the day, what did we really do? We literally paid off over the course of this period of time, which was about 8 years in total with all the college. We paid off $561,000 of debt and would have been debt with college. How much of an interest rate did we actually recapture and take? It's an average of 9.32%. It would be more, but we only accounted for 4% on the tuitions. But really, here's the fun part. So I'm going to write down 2 numbers on the screen. Okay, I'm going to write down 2 numbers, and these are big numbers, so I want you to kind of just look at them, and then we're going to talk about what these numbers really mean. All right, so let me ask you, do you know what these numbers are, Maureen?
I have no idea.
Do you want to take a guess?
Money I saved?
Correct. This is the amount of money you would have given away to the car company and the credit cards in interest. This is the interest that you would have given away, but you recaptured, and you got to keep all that. This is the amount of interest you would have given away for college over about 180 months. So this is the college interest that you got to keep. All in total, the net result was you saving $178,236.
Holy cow, that's a lot of money.
So that's how much money you saved that you would have given away. That doesn't account for all the other things that came along with this. Doesn't account for the retirement house, the passive income rentals, doesn't account for anything else outside of interest that you no longer had to give to somebody else. That is the power of being in control of your money. That is the power of the money multiplier, and that is the power of following the mapping process. All of which are things that we are now doing for you, and this is your new reality. So welcome to the family.
Chris, thank you, and the whole money mapping team. I can't even thank you enough for saving me, recapturing me, and taking me into this new family of yours. I love it.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.